You haven't invested much or really at all, it can be very complicated, very complex when it comes to investing. That is why a lot of people avoid it in their entirety. They don't even manage their 401k. It just kind of sits on autopilot. So in today's video, we're going to be doing some straightforward advice to make you a smarter investor. Now, the first one we look at is sticking to quality investments. Now, when you look at Warren Buffett, when you look at Charlie Munger, there's a very specific way to do this. It's better to buy a wonderful company at a fair price than a fair company at a wonderful price. That means that you are overpaying for that and you're not finding the value. You always want to look for the quality of the company if you're investing in individual stocks, which I do not recommend. Now, with the quality, it is really companies that can stand the test of time, that can also be a very affordable investment. There's a lot of different ways that you can look at this, but overall, when you look at some of the big companies in the S&P 500, when you're talking Nvidia, when you're looking at Tesla, when you're looking at these larger companies that have a track record of a multitude of years, but even when you dig a little bit deeper, when you start looking at the Home Depots, the Coca-Colas, some of the brands that have been around for, 50, 100 plus years, that have and really built a lot of quality products. And they service the community, a lot of things like that with a quality investment. Now, of course, this doesn't mean that you have to invest in those specific companies, which I do not recommend. I recommend, and I really stick to it, going for those ETFs or those index funds, making sure you're looking at specifically a market index. Now, again, if you're relatively new to investing, if this is your first time, if you're really starting to do your research and get the experience with investing yourselves, look at your ETFs. They can actually mitigate your risk. They come relatively cheap. Now, one of my favorite, of course, is the VOO, which is the Vanguard S&P 500. It brings in the top 500 companies within the S&P 500. That's essentially where it does get its name. This is the 500's largest publicly traded companies within the United States. It's very easy to invest. It is a relatively safe option. It has a very low entry fee, meaning the expense ratio in there is a 0.04, which again is incredibly low when it comes to investing. And over the last century, it yields a 10+% return. When you start thinking of those high yield savings accounts, when you start looking at a lot of the CD rates, if you're getting 3%, 5%, even 6%, it can't hold a candle when you're getting 10+% per year just investing in that S&P 500. Now, when it comes to investing, you have to know, one, exactly how much money you're going to invest, and two, what is the time frame that you're looking to invest. Now, the general rule of thumb, when you're holding your investments or buying investments, you are going to hold them for 5 years. This means it's going to include the good times, the bad times, the market up, the market down. The consistent growth comes from the long period of investing. When you invest year over year, the increase is about 20% or more, depending on how much you're putting in there. And even when it decreases, it can decrease by that much. But when you look at long-term investing, the growth factors are there. It has been proven for a multitude of years. When you look at short-term investing, and we're talking 1 to 3 years, you're kind of rolling the dice with those investments, not knowing exactly what you're going to get because it is a shorter time frame. When you even stretch out that time frame further than holding them at least 5 years, when you start looking at 10, 20, 30 years, regardless of almost all of the ETFs that you go through, if you're going back 20 or 30 years, they have a pretty strong growth record, which is awesome. Now, of course, with long-term investing, you are maximizing your success. There'll be market downturns, but there has to be a point, and this is honestly the turning point where I changed my investment strategy altogether, was not having the emotional attachment to what you're buying. So the way that I view the stock market is, if the market is on a flat day, that's great. If you're buying or selling, it is what it is. If the market is down 5%, 10%, 15%, that is a huge opportunity to get all of the ETFs that I love to buy so much at a massively down or massively reduced cost. When you think of something being on sale, including, the stock market, including those S&P 500s, if the market is down 10 or 15%, most of the people will sell. Me personally, I love a discount. I love when the market is down. I love it even when the market is down for a couple weeks. In 2022, when the market's seen some steady declines, I was buying like crazy, and it has been absolutely amazing. Because in 23, when the market really turned up in Q3 and Q4, we seen some massive gains in the portfolio in the tune of over a 60% growth rate in the portfolio as it sits today because of dollar cost averaging and holding those investments. Now, for the investments in general, I have 2 years in, already north of 2 years, and we're almost at $100,000 in that investment portfolio, and it is continuing to grow. We're starting to see a lot of the growth factor in there, also seeing a lot of the dividends that are coming in from the portfolio we have. The next one we look at is making it automatic. I cannot stress this enough. When you look at Ramit, I will teach you to be rich. It is really the personal finance. It is very simple, including the aspect of investing is if you do it automatically. This could be your 401k, this could be your IRA, this could be your HSAs, this could be traditional brokerage accounts. You want money going in there automatically. Now, the bare minimum that we want to see in these accounts are 10%, but if you follow Dave Ramsey and a couple other financial gurus, you're looking to get up to 15%. So what that means is when you start a new job at your current job, whatever it may be, you want to make it automatic and you want to pay yourself first. So you want to set the contributions up to 10%. And this is at 10% if you have a match. If you don't have a match, you want to make sure you're setting aside money because this is going to give you the ability to compound growth over time. Again, when you start looking at those 10, 20, 30-year timeframes, you can exponentially grow your investment to millions, if not multi-millions, depending on how much you're putting in there, if you give it enough time. You have to put it in each paycheck. You have to make sure knowing exactly what it's invested in. Now, me personally, I do not like the target date funds. I know a lot of people invest in target date funds, but overall, when I compare target date funds to the S&P 500 or even large cap, mid cap, small cap, stocks or portfolios, it seems like they perform a lot better than what I've seen the target date funds. So again, make sure you're sitting down with a financial advisor or doing your own research to know exactly what you're investing in. Now, of course, when it comes to IRAs, you want those IRAs invested. When it comes to brokerage accounts, you want it invested. What I see a lot of people doing is they have IRA money, they park it into a bank or a credit union. It is earning very, very minimal returns. You want to make sure that you are maximizing the growth factors in there. And again, what I personally use, down below, there's some links to Robinhood. There's also one to M1 Finance, which is what I use for all of my investing. They have those IRA accounts you can put money into, invest them in the market, invest them in those ETFs that I talk about. And that way you have the growth factor, making regular contributions. Now, of course, with the 401ks, you can put a lot more money in there than you can with the IRAs. So depending on your investment strategy, you want to make sure, and also what you can invest in. For instance, if you're investing in a 401k and the company that you work for, the provider that they work with that 401k, has absolutely horrible investments, it might be the point where you put 4% to get your 4% company match. That other 6% is going into an IRA if you can contribute to the IRAs, or it's going into that traditional brokerage account. So you're still putting in that 10%. You're just being really financial savvy and really smart about it and making sure that your investment portfolio is in the ETFs and the stocks and the bonds that you want it to be. Now, using CDs and savings accounts for short-term goals. This is where you're going to be looking at your emergency fund. This is also where you're going to be looking at parking your 1 to 3 year money is really a huge part. Saving versus investing. Investing, again, we look at 5+ years. If you're looking at savings, now this could be going on a vacation, building that emergency fund up. It could be saving for a house, saving for school. As long as you know the guideline that you're talking. So let's say me personally, I want to do a SMART goal, specific, measurable, attainable, relevant, and timely, meaning that let's say I want to buy a house in the next 3 years. It's not a good idea to put all of your money into the stock market because if it does have a bad year or two or a down year or two, chances are you might not be able to buy that house if it's down 10, 20, 30% because you just lost a majority of your down payment. Now, smart way to do this, put it in CDs. So if I know, again, X amount of time, I want to buy a house in 3 years, I want to have $40,000 for a down payment. I can go ahead and put it into some short-term CDs. As I'm accumulating money, I can put it in those high yield savings accounts, which right now are paying roughly 5%. Again, down below with M1 Finance, you can definitely pick it up. CDs, 3 years are running about 5%. You can even find a lot of shorter terms where 9 months, 12 months, even 15-month CDs that are paying north of 5%, which again, if you look at that, you're getting a pretty good return on your money for keeping a majority of it liquid. Even though the CDs are a shorter term deposit for a majority of them, you know exactly what you're planning for. So when it comes to investing, it is a lot easier than people realize. If you open an account with Robinhood, with Webull, with M1, and you're putting money in there, let's even say 50 bucks a paycheck, you get paid every 2 weeks, you are going to be shocked with exactly how much money you're putting in there when you're buying those index funds, when you're putting consistent contributions in there on a regular basis. It is going to make a big difference when it comes to retirement. And trust me, the future you is absolutely going to thank you when it comes to the money that you put in there. So definitely let me know in the comments if you are a smart investor, and I'll catch you in the next video.